Also bring on board then Dipan Mehta, who's joining in on the show to share with us his outlook on the markets as well as some individual stock recommendations. Hi there, Dipan. Good to have you on board. Why don't we start off by talking then about what happened when it comes to Britannia in terms of the kind of quarterly earnings. If you had to compare it to some of its other peers within the FMCG space, it definitely stands out as a shining star, at least when it comes to earnings.
Yeah, good afternoon, and thank you for having me on your show. Yes, I think Britannia has been an absolute outperformer within the FMCG space, and they have done so consistently for the past several years or so. And steadfastly, they have gone about increasing their manufacturing plants and their retail footprint and really taken on the parlay, which was the market leader, and increased their market share as well. It's still a company under transformation. They want to go from biscuits to complete food company, and that's something which the investors are keenly following. Valuations have been on the premium side, but looking at the kind of numbers which keep coming through from Britannia, perhaps well justified. The only fly in the ointment is the unsecured loans which the company has given to group companies, and that always, has a bit of a cloud on the company, that could there be any delays or any corporate governance issues over there. But by and large, I think there have been no such events, and the company is earning very good return on the money which they have lent to group companies. But I would say that if you're invested in Britannia, remain invested. This is a company which is still in secular growth mode at a time when most other FMCG companies are operating in very mature categories and showing flat volumes. Here is one company which is still able to manage double-digit growth rates, at least on the volume front.
Okay, Dipan, just stay with us. I'm going to get right back to you. In fact, take your opinion on Paytm up next. But here's Hemang Jani telling us why is it that he likes AB Fashion and Zomato.
The overall consumption, story is not that bad. Yes, because of either raw material changes or operating costs, the operating numbers have not been great. So I would rate Aditya Birla Fashion as one of the companies which will remain there as a top company, in the retail space. And the stock has corrected. So typically you should be buying into such franchise when the sentiment is not good. So I do think that, names like Aditya Birla Fashions, Trend, should do well for investors, even from current price level. When we look at the new age companies, recently we have initiated buy, call on Zomato and Paytm. And the reason why we like some of these companies is that, on the one hand, the market caps have actually come down by about 50-60%. And when you look at the actual underlying operating performance, it has shown a lot of improvement. And we think that some of these companies, once they reach a certain level of operating profit or EBITDA, can actually grow very fast.
Right. Dipan, have to talk about Paytm and especially the commentary this time around from Vijay Shekhar Sharma, reiterating not just that their losses have narrowed, but the fact that they are saying that they're going to maintain profitability and focus on generating free cash flows.
Yeah, I think ever since listing of Paytm, that's been the biggest bugbear with investors, that when is the company going to turn profitable? And now I think that particular event is very well in sight. Very impressed with the way they have curtailed the expenses. The value proposition of Paytm remains strong as ever, and some of the innovation which they have done, like the sound box, is really, I think, quite impressive, and that helps them grow the merchant network. And then it's a platform. More and more people there are on the platform, then they will look at other services and products offered by Paytm. And I think the strategy is clearly playing out, because if you see the kind of earnings which are coming in from organizing loans or from some of the other financial products, is steadily growing. And that is covering a lot of the losses on the basic payment business. So I think the entire, company, its strategy, its core business performance is all playing out pretty well. And at some point of time in the near future, you could see a quarterly profit. And I think that could be a very important inflection point for the stock as well. It's a one of a kind of a story, and will always trade at premium multiples. So I think generally view is positive on Paytm. And going forward also, it can now, I think, good bottom has been formed. And going forward, it can turn out to be an outperformer.
There you have it. That's a view coming in on Paytm. But we've got lots more stocks that we'll be highlighting. These are the stocks on the editor's radar. We're handpicking two large cap names. And let's start off then in the banking space with IndusInd Bank. Jefferies has got this stock on their radar. They maintained a buy rating, a target price at about 1550, highlighting that the CRO's resignation shouldn't warrant any price correction.
Unfortunately, with IndusInd Bank, even though they're delivering, markets are not enjoying that comfort. IndusInd Bank was trading at 4 times price to book before the LNFS crisis. Post that, markets have lost their comfort, so to speak, because what they had shared, they've not delivered, and now it's taking their time to perhaps get that confidence back. Typically, when a risk officer of a bank, where you know that markets have been unhappy about the numbers in the past, they resign. Markets say, "Arey, kya ho raha hai? Is there something much more than that meets the eye?" And the market reaction, I think, was visible in last 1 hour of trade on Friday. I think IndusInd Bank is a cadre-based organization. We must recognize that some of the organizations like IndusInd Bank are built to last. So an individual may not be having such a large impact. It is not that, HDFC, it is not that there is a sudden exit of HDFC Bank, Aditya Puri from HDFC Bank, that it really changes the vision. Here's a routine risk officer and risk management in any bank of the quality of IndusInd Bank, which is process-based. An individual really cannot have such a large impact. So because markets don't have large kind of an comfort, it's a high beta stock, we saw this kind of an sell-off. I expect the stock to bounce back because the market reaction on Friday was overdone.
Yeah, unwarranted according to Jefferies as well. Let's move on then and discuss Cipla. It's going to be in the spotlight come May 12, especially because it will be declaring its quarterly numbers. And the street, Nikunj, seems to be penciling in that it could be a pretty strong quarter.
I think markets are underestimating the potential of Cipla's domestic business. I know it's an expensive stock, but in a sense that the franchise what they've built and the kind of market share what they've gained and the kind of growth what we've seen in the domestic pharma business, I think is quite extraordinary. Avan, while we always think that US in pharma means US generic, we must recognize that the real bull run isn't in the Indian economy. In America, they have to cut corners to bring the cost down. So the US generic business will always be under pressure. But in India, it's very simple. We will be consuming better medicines. We would be consuming better quality healthcare. Cipla is a force to reckon with. They've got a very large portfolio both in diabetes and in the chronic care. And I think they've done a wonderful job in terms of maintaining their margins as well.
And so it's flu season is rampant.
Flu season is rampant. Their portfolio is quite decent. I mean, the company stands for a cause and for a purpose. So I would like to say that Cipla for me is more like a Rahul Dravid. It may not be very exciting if you buy the stock, but it's going to be stable.
Yeah. Okay, that's the view coming in, cricket analogy and all that. IndusInd Bank, Aisha, as well as Cipla, stocks on the editor's radar.
Oh yeah, absolutely. Kunal, let's talk about the pressure points from Friday. IndusInd Bank and the HDFC twins. Do you think they're going to make a meaningful comeback or will they still remain under pressure?
I think they should be under pressure for some more time because we've seen for the first time, as I said, that we've seen an unwinding of contracts on the individual stocks, large cap names, and that generally takes a lot of time because when you see such kind of sharp impact in terms of prices, whether it's even if I can probably add maybe Federal Bank, it was the impact which it created, which all of these stocks created on the Bank Nifty, and that impact could probably dent the prospects for Bank Nifty over the near term. So I would not expect very immediate kick-off momentum for these stocks or a sharp V-shaped recovery for these names. These stocks have already done pretty well for themselves, as a basket overall for the private sector names over the last 1 month, specifically from the March lows of 38,500 for the Bank Nifty. So I think it would be more of a cool-off time for the private sector banking names. I think I think traders should not be in a hurry to try and jump in the stocks just because they've corrected 5%, 7% on average. You have to wait out for maybe another 3%, maybe another 5% correction, and then could probably go in for opportunities on the contra side.
Okay, before we move forward, Dipan, just a quick call from you. I mean, IndusInd Bank with the CRO resignation or a whiff of that and the way the stock cracked off on Friday, or for that matter, that MSCI adjustment playing out for HDFC Bank, would you be a buyer on such decline days? Or have you bought already?
Yeah, we are more or less well invested in these two companies. But yes, I think positive on both IndusInd Bank as well as HDFC Bank, and maybe HDFC Bank is going through its pains as a merger because of the merger. But once that is over and done with, I think again you could see a very secular growth coming through from HDFC Bank. And I was pretty impressed with HDFC's numbers as well. And of course, eventually that will start to flow through HDFC Bank, the merged entity. So on the whole, I think it's a good stock to have as part of your core holdings. Coming to IndusInd Bank, I completely agree with Nikunj that it's a high beta stock. And, ILFS clearly exposed its lending practices where NPAs shot up. But there's been a change of management since then, and the new management has been steadily trying to improve its systems and processes to ensure that such a repeat situation does not arise. But the underlying sectors to which IndusInd Bank lends to, that is vehicle finance, microfinance, and to the jewelry industry, those are intrinsically quite risky. One needs to keep in mind that there will be some certain degree of volatility in IndusInd Bank's earnings, especially when the NPA cycle turns. But valuations are really attractive for IndusInd Bank. It is trading at a huge discount to its maybe 10, 15-year type of a price to earning multiple averages. And that's because of the past, these are, I would say, last 2-3 year track record of the company. So, I mean, if you're invested in IndusInd Bank, I would remain invested, but I think there are better choices within the banking industry where banks are performed even better on a consistent basis.
Stocks, and is it a coincidence that you own all 4 stocks, or are we only discussing stocks which you own? Dipan?
No, I have a very large portfolio, having been around for a long time. And, that's the reason why we end up owning so many banks. And actually, when you look at the entire spectrum of stocks in the country, and you want to go for secular growth stories with a wide footprint for growth, then your obvious choice has to be banks. Also, banks have a very large weightage in Sensex Nifty, which if you want to benchmark yourself against that, then you have to have a high proportion of your ownership in such stocks. And thirdly, I think by and large, there is a lot of corporate governance comfort when it comes to banks. They are highly regulated. And on the whole, I think their ROIs also are pretty decent. And at this point of time, valuations also are quite reasonable. I mean, Axis Bank, ICICI are available at very reasonable valuations. As the HDFC Bank, I think we bought at much higher price to earnings multiple. So there are a lot of choices. And at the same time, as I said, I think the consistent growth in earnings seems to be possible for next 2-3 years or so.
I'm going to shift gears and talk about IT. Dipan, at what point in time IT becomes what banks were in 2021? 2021, nobody liked banks. Everybody was worried about the impact of COVID. Everybody was worried about what essentially will happen to their balance sheets. But those who bought banks in 2021, they hit a home run in 2020, 2023. Are we reaching that point in IT where there is a lot of disbelief, nobody likes them, and it's time to now pick up your bargains?
Yeah, Nikunj, you're right, but they're not really cheap as well, no? I mean, if I want to strategize for IT for the next 5 years or even longer, clearly my preference has to be for mid-cap IT, the likes of Persistent Systems or Tata Elixir, Coforge, those sort of companies which have really grown significantly last 3 to 5 years, have shown solid 20% plus type of revenue growth rates and steadfastly maintain their operating profit margins, manage the entire environment and also the kind of attrition pretty much well, and created very strong niches for themselves. But these companies are still trading at very high P multiple, premium to the larger ones like Infosys and Wipro, HCL Tech Mahindra. So while you get the comfort that maybe 1 or 2 quarters may still be bad for IT companies, but then it's not that they're really cheap. And way back in 2020, banks were really at attractive P multiples as well. So it's just kind of a wait and watch and see how this thing plays out. And maybe if you find that the stocks, these mid-cap stocks go nowhere for maybe a year or so, and earnings go up by 25% or so, then that could be a good entry point. I would like to just buy these mid-cap IT stocks at slightly more reasonable price to earnings multiples, so there's margin of safety.
Tech Mahindra be the dark horse, Dipan Mehta. There's a change of guard there. This is one company where the intent of the promoter group is to turn it around. They've turned Mahindra and Mahindra. They've turned around Mahindra and Mahindra Finance. They've turned the auto business. Tech is where they have a scope. It's like work in progress. The company is not lived up to the Mahindra brand. Could next 5 years be different for Tech Mahindra?
See, I think I'll wait for the results to speak for themselves. They are in the telecom space, and we are seeing that 5G will eventually drive tech spending within the telecom space, but that's not visible so far. And the company clearly has lagged its peer group. So I just like to wait for more consistent numbers, industry outperformance before I look at Tech Mahindra again. As I said, right now the focus is on a lot of the mid-cap IT stocks. We're trying to find the next, maybe Persistent Systems or KPIT or Tata Elixir for that matter, because really these mid-cap IT companies are creating very strong niches and they are able to compete very well with the large cap IT on their turf. Even as the industry matures, I think there is clearly understanding that mid-cap IT stocks do bring value to even the largest or the Fortune 500 customers. And mid-cap IT, I think small acquisitions, 30, $40 million orders, very specific position in a particular vertical, could be auto or could be IoT or AI or any specific niche vertical also ensures that they grow at 15-20% thereabout top line. And that's what we are looking for in a company. I think more and more the larger IT companies, the base effect is drawing them down.
Naresh, one of your favorite stocks, Aditya Birla Fashion Retail. Why it is not going higher?
So it used to be a favorite. Finally,
You sold it.
Booked out of the losses.
You never told us.
Yes. I think I told it before also, but the fact is now the stock after that also sold it in a loss at 300 odd levels and on the way down. Technically, the stock went through a one-way downtrend in the last few months, which was surprising. Even now, the stock is available at the same prices as it was pre-COVID. So technically, would wait for a turnaround, and I'm not afraid to getting back in whenever the stock is turned around. So out here, the risk reward is still okay, given that the 200 price was there pre-COVID, the 200 price was there in 2016. It has been a stock which has not delivered. There were many expectations. So for now, the last bottom is at 200. I would wait for a tick about 230 to start getting bullish.
Okay. I'm going to change gears and move back to a repetitive question, which is on HDFC Bank. Kunal, let's take HDFC Bank out of the equation. If you take that out of equation, then how are markets looking?
Yeah, even if you take you include HDFC Bank, the markets are still looking very attractive and positive for itself. We've seen a very good recovery for the index from the last 1 month. And if you include HDFC Bank, then it just adds more flavor that the large cap stocks in the last 1 month have been more stronger as compared to what has been earlier. So, just to give a different texture, that in the last 1 month, the likes of ICICI Bank, the earlier favorites in the last run, that is in second half of 2022, from the September lows of 2022, ICICI Bank, IndusInd Bank, these were top performers, and even SBI were top performers in the second half of 2022. Surprisingly, this time around, you have the likes of Kotak Bank, you have HDFC Bank. So if you exclude Friday's price action, they had actually done exceptionally well for themselves, coming very close to their respective 52-week as well as lifetime breakouts. And that added the flavor for the markets as such. Now look at it this way, that most of the other PSU banking names which were doing cartwheels in 2022 in the second half, they are most of the stocks are nowhere close to their 2022 highs for themselves. There is a margin of at least another 10-15%. So this move which we've seen in the last 1 month was more dominated as well as led by large cap names. That makes the setup more formidable as compared to what was in second half of 2022.
Naresh, wanted to get in your take as well on some of the stocks that saw breakdown in Friday's trading session. What's the outlook on BHEL, and have you had a look at the charts of a Dabur?
So BHEL is still interesting. The stock had seen a very sharp move previous to this. The stock saw some bit of this correction due to some notification around coal plants. Technically, the last breakout was around 78, 79 levels, which is where the fastest move came from. So I would expect it to pause around 78 levels. I would be actually looking at a buy around 78, 79 and keep a stop loss below 76 and expect a bounce back again towards 90 levels. So positive on BHEL. Also, the fact that the whole capital goods segment has done really well. BHEL was a laggard, tried to catch up and again has taken a little bit of a dip. So risk reward trade on dips to 78, 79. Dabur is something which I'm not really interested in. The whole FMCG pack has seen very different moves. Some stocks are hitting 52-week highs, some stocks are closer to 52-week lows. So there is no structural trend in the sector as such. And in that, Dabur has been a disappointment over the last few months. The stock is back to the prices where it was a year back. Also, almost the whole return from the COVID rally, which started in the stock, has been negated now. So not looking at it, a relative underperformer, there are better choices available in the FMCG pack as well.
Okay. I just want to look at the numbers which came out from Britannia, because numbers came on Friday. We've discussed Britannia extensively, but these are good numbers and the margins are expanding. Guys, remember, margins have expanded for Tata Consumer. Margins were looking okay for Britannia. Dabur, not so great because of their focus on rural economy, which in a sense has been a bit of a struggle. There have been ONDC. Now, this is something which is path breaking. While there are banks which will benefit, there are merchants who would benefit. What happens to Swiggy and Zomato? There are a lot of screenshots which are flying around in social media and WhatsApp groups that suddenly the ONDC network, if you order a burger, it is 30 rupees cheaper.
Yeah, that's right. I think that certainly does open a risk factor for Zomato, but it also opens an opportunity as well, because on the ONDC, as I understand, you still need delivery partners, and maybe Zomato could offer just its delivery services over there. So I think it's a very volatile and fluid situation, and the success of ONDC also needs to be tracked very closely, because quality assurance is a big factor on ONDC. Which other platform companies, be it Swiggy, be it Amazon, do offer, and the comfort level is higher with such platform companies than newly established ONDC. So I think it'll go through its phase of maturity. It'll go through its phase of understanding and acceptance. But for the time being, I think Zomato and Swiggy are going from strength to strength. It's a fabulous duopoly, and they are changing habits as far as consumption is concerned. Eventually, it's going to become more and more mainstream ordering food from outside than cooking at home, especially with the millennials and the Generation Z. So I'm still quite positive on Zomato at its present valuation. But yes, you have to keep an eye on all the disruptions which are taking place within the sector. So, I mean, Zomato was a disruptor itself. Who knows, it could get disrupted by something else like ONDC. And it's not that you're going to bet the bank on a stock like Zomato. It's just that you want to have a small position in it, because eventually I think if they're able to show profits and go fabulously in the black, then this stock could be a multi-bagger over a 5-10 year period.
Let's say if you have to bet the bank or have a very high disproportionate allocation for next 3 years, what are those names where you would say, look, the index weightage is 5, I'll keep 10, or I've had a 5% weightage historically, I'm happy to make it 15. What are those 2-3 names where you think you want to be overweight or have a disproportionate amount of weightage?
So, Nikunj, first we have to have a very strong disclosure in place that if I'm going to say these names, then I have a personal positive bias for these companies. They're not recommendations for investors to buy, but at least we are putting our faith in these companies as of now. So on the top of the list is Larsen and Toubro. And you've discussed it extensively, so have I. We need not go into the reasons except to say that it's in a fabulously sweet spot. And with the way the capex cycle is playing out, elections down the line, government spending going up, this is one company which will benefit significantly from whatever is happening in the environment. A lot of value being created in the subsidies as well. So this is like, and I would create it as among the core holdings. The second company I think which comes to mind is Cholamandalam. We've been consistently following this company for several years. Very impressed with the way they handle the IL&FS crisis and thereafter the COVID crisis. And it's a fabulous lender, very good systems when it comes to managing the risk. Compare them with Shriram Transport and M&M Finance, and you will realize how good they are in terms of managing their risk. The third company which comes to mind is Eicher Motors. Again, we've discussed it extensively. We like the premiumization story which is taking place within the two-wheeler space, and exports is a huge opportunity for Eicher Motors. It's not as much being, I would say, the threat of EV is not as severe for Eicher as say for Bajaj or TVS or Hero MotoCorp for that matter. And Eicher, of course, has its own plans as far as EVs are concerned. So that's the third company that we are quite positive on. And I can go on. There's Praj Industries that we like a lot, given its position, and the ethanol blending program is going from strength to strength. And massive capacities need to come up as far as distilleries are concerned, and that's where Praj has a very important role to play. So I think like that, our basic preference is capital goods, banks, automobiles. I think these are the three engines that, or I would say verticals, which we are quite optimistic on. We're trying to find the best companies within these three industries.
Right. Okay, Dipan, stay with us. Lots of stock ideas you've given our viewers. So we're going to just quickly take it across and talk about Go Fashion's numbers and muted Q4 actually for the company. Gautam Saraogi, the ED and CEO, joins in to talk about the way forward for the company.
See, usually for us, quarter 3 is the best quarter in the year because of festive. And quarter 4, immediately after festive, is usually the weakest quarter for us. So the fall in revenue from Q3 to Q4 is very normal in the normal course of business for us, in our type of business. So the fall is genuine, and it happened even pre-COVID. As far as slowdown is concerned, there is a slight slowdown in Q3 and Q4, which we are seeing that there is an improvement in April onwards. See, the 8% market share was based on a FY20 number. We are, over the next 2-3 years, we want to get to at least a 14-15% market share. We would at least want the single-digit market share to go into double digits. So 14 to 15% is going to be our aspiration number over the next 3-4 years.
Let's actually look at in the pre-open session where HDFC Bank is, where TCNS Clothing is. Now, look, Itina broke the story that Aditya Birla Fashion will acquire TCNS Clothing. But in a sense, the fine print is starkly different than what we were anticipating because it's a share swap. In a share swap, the equity of Aditya Birla Fashion will get diluted, and shareholders of TCNS, they will get shares of Aditya Birla Fashion. And the deal has been done at a disproportionate discount to what the Friday's closing price was. So I think rather than selling it now, one is better off holding the stock. This will also lead to some dilution for Aditya Birla Fashion. Aditya Birla Fashion in the past has been a company which is in a sense trying to move into a lot of formats. And this is where I think markets are also realizing that what are they trying to do? They've got multiple platforms, multiple businesses, all of them have high growth potential, but somehow in my book, I think the focus for this company is missing. It's Aditya Birla Group brand, great franchise, strong, formidable brands, but are they spreading themselves too thin? Then I just wonder, are they spreading themselves too thin? I look at Trent and I say, wow, look at the way how they are running West Side or taking their brands higher. But Aditya Birla Fashion is just moving into everything.
And Akunj, you look at Trent and you say, wow, but you look at the PE multiple also and you say, wow, again, it's trading at significantly higher PE multiple. I don't know whether the growth rates, although they are superior, justify that kind of price to earning multiple. And, we have seen this play out within the retail industry with DMart as well, where valuations were absolutely skyrocket at sky levels. And then as the growth rate started to slow down, we have seen the stock underperform. And therefore, P multiples also eventually compress, although earnings have been pretty much steady 15-20%, maybe slightly higher as well. But if you ask my opinion, I think the best way to play retail is through specialty retail companies. And you spoke about one of them just now, Go Fashion. There are many companies like this. I think 7-8 companies. Go Fashion is there. Then there is Manyavar. There is Metro Brands. You could add even Landmark Cars to it. Ethos. I think all of these companies, the common thread is that they are focused on a specific product category. There's a huge runway for growth for them. They just have to expand their network. The balance sheets are strong and they can support a network expansion. And we are seeing that they are ahead of the changing consumer trends, preferences, which is why I think their growth rates will be significantly higher than the likes of Aditya Birla Fashion or Shoppers Stop or even some of the other retail companies. Also, they are in highly value-added products, trying to build a brand as well and create a moat for themselves. But of course, I think these companies are also pretty much expensive. I think that's where investors will find the next group of winners within the retail space, and not large format department stores, which are going to be competing heavily against the online players as well. I know that these companies I mentioned also have threat from online players, but their position is such that, I would say the threat is significantly less than the likes of some of the large format companies.
Let you go on that note. Thanks so much for taking time out and joining in and sharing with us your outlook on the markets as well as those individual stock recommendations.